Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Let's tell you the top headlines at this hour. Indian markets begin the week on a weak footing as oil price rise hurts companies with sizable exposure to crude. The volatility index is trading at a 3-year high. Oil marketing companies are among the biggest losers in trade today after US says it won't extend the exemption granted to some countries on Iranian crude imports. SpiceJet and Emirates enter into a code-sharing agreement as the two airlines try to make the most of Jet Airways shutdown. And 300 people were killed in coordinated explosions in churches and luxury hotels in Sri Lanka on Easter Sunday. The police have detained 24 suspects. Good afternoon, Neeraj. Well, it's clearly not a great start to the expiry week. The selling pressure is just intensifying, I guess.
Yep, and oil is to blame, I guess. I would presume that's the principal culprit. We'll have extended conversations on this during the course of the show as well. But this is how the markets are stacking up. Down about 1%. Down about 1% for the Sensex and down more than 1% for the Nifty Bank in the session today. So stress across the screen. The broader markets too have performed poorly, and the market breadth would stand testimony to that. About 1% lower for both of these, and I don't think there would have been any attempt at a pullback. As you can see, zero attempt at a pullback. The reds have only trended higher, the greens have only trended lower, and the advanced decline ratio currently worse off than 1:3 in favor of the decliners. That's the key thing. So keep that at the back of your mind. However, just the turnover that one will pull up once, and India VIX and how it's expanded before we talk about individual stocks. So first the turnover, and 5 lakh crores done on the F&O side. The cash turnover is a bit lower today. I believe we'll struggle to hit the 30,000 crore mark on the NSE cash. The volume's markedly lower today. It'll be interesting to see what the FI numbers are in the session today. And then the India VIX, as I said, it's expanded even further, 5.3439%, 24 odd levels. I know typically these are levels from which we tend to retreat for the markets, but election times, these levels have tended to move up higher, as we've seen in 2014 as well. So maybe not quite done yet with the higher volatility. People buying protection. Quickly get the heat map and show you what's moving and what's not on the index. All marketing companies down there. Yes Bank, Indiabulls Housing Finance, Diwan Housing Finance, all three are culprits of fall today, and sharp cuts in each of these. So this is an important pack to monitorable. They tend to move in tandem at times, and that's what seems to have happened today. Reliance Industries is down about 2.5%. Some pullback in other rate sensitives. So Maruti, Eicher, Axis, M&M. So that entire rate sensitive pack, autos and banks have corrected. What's done well is IT. That's the only pack which is kind of holding out, in addition to defensives like HUL, which are lying very, very flat in the session today. What about the mid-caps though, Devina? A lot of pain. I believe all sensitives would have reacted in the mid-cap end too.
Yeah, most of them. In fact, if you see the tire companies, if you see the paint companies, HPCL not a part of the index anymore, but in line with what the rest of them have done, HPCL too has taken a knock to the chin. But individual stocks again, and taking a look at not just the index, which is down about 1.25%, but a few stocks that have seen heavy cuts in today's session. First off, you've got a Reliance Capital and you've got a Reliance Home Finance. Both of these counters, their debt instruments have been downgraded by Brickworks and Care Rating. Both of them heavy cuts have been seen, and Diwan Housing Finance also sees a commercial paper rating cut, and that comes in from CRISIL. And Diwan Housing Finance is taking a knock to the chin in today's session as well. That's down about 9%. Other stocks which are seemingly doing okay in a falling market, you've got Indiabulls Real Estate, that's up about 3.5%. Sterlite Tech, that moves up too, takes a breather. In the recent past, you've seen Sterlite Tech witnessing some amount of pain, and that has reversed in today's session. And a DCB Bank, a good quarter, decent numbers. More than 10% growth quarter on quarter in terms of profits. I think at about 96 crores is what they reported in terms of their net profits. But that's doing well. Stocks on the back of heavy volumes. You've got a Radico Khaitan, which is trading with volumes of about 8.5 odd lakh shares, up about 2 odd % in the session. Tata Coffee, good set of numbers, met street expectations. Stocks up about 2.5%. At Rain Industries, with about 35 lakh shares that have been traded, the stocks up about 2.5%. Near 52-week lows, though, in today's session is HEG. 1940, I think, is the 52-week low. So just about 4 points away from that. And I think 526 is the low point for NATCO, 52-week low, 4 points away from that. So watch out for all of these names. And obviously, as the last 1.5 hour of trade kicks in, you're going to witness a lot more volatility coming back in. But let's take a look at the more liquid space and the futures and options segment and what's happening there about. Navneet's going to highlight that for us. Navneet.
For that, Devina, well, the picture is not looking great at all. Obviously, the positions are now being rolled over to the May series. And remember, that series is going to be even more volatile, considering we will be getting the results of general elections towards the end of the series. But nevertheless, for the day, you've got the Nifty as well as the Bank Nifty. As you can see, the rollovers are flashing there on your screen for the month of April, which expires this week on Thursday. Open interest is up nearly 3%. We were actually watching out for the 11,650 level for the day, which has been breached because there was lot of call writing taking place around the 11,700 strike at a time when premium was nearly 50 points. So that's been breached for the day. Bank Nifty is also weak. Remember, Thursday's closing was not that great and the selling pressure has continued today as well. So for the May series, now the open interest is up 21%. We've been talking about India Wix a lot, and today it's almost at 3-year high, 5.5%. It touched the level of 24 in today's trading session. In terms of option strike, as I mentioned, 11,700 is something 650 on the downside that we were watching. So 11,700 call strike has been pretty active. 29 lakh shares so far have been traded, and obviously the premium has fallen because the markets are down and a lot of writing continues. On the put side, we've seen somewhat addition coming in for 11,550 and 11,600. Clearly, the next focus on the downside will be the 11,600 mark. Watch out for that. But maximum OI for the series is at least at the 11,500 point. Some of the stock futures which are in focus, Jet Airways, which came out of the ban period for today's trade, and clearly it did give a room to create fresh shorting in today's session for the F&O traders. The open interest has surged significantly. Fresh shorting continues. The stock also touched all-time low levels. There you go. For the May series, the open interest has surged quite significantly. DCB Bank is the other one, reacting pretty positively. One of the top F&O gainers for the day, and good amount of long position seen there as well. The stock's also hit, by the way, 52-week high post its quarterly earnings. Nothing happening around Sri Cement, but I was just observing the data. The open interest has surged, so watch out for this one. Divan Housing is the other one. The stock stumbled nearly 18 to 19% in the last two sessions, and for the May series, definitely there is some shorting which is visible on the screen right now, guys.
Okay, let's begin the show with a global voice. Zhou of Commerzbank is joining us on the show with his thoughts on what's happening in the markets currently and what could be the key monitorables. Good having you. Thanks much for joining in. In India, we are besieged today with what the impact of the higher crude prices would be on the economy, on the markets, and on how foreign investors view investing in India, because crude has typically been a big bugbear. What are your thoughts on what is happening on the supply side led uptick in crude prices and what it could do for the sensitive emerging markets which react with higher or lower crude prices?
Yes, I think it's very clear that the crude oil prices are on the rise at this moment due to supply concerns. And on the other hand, we do see that some of the emerging markets at this moment are under pressure, especially India at this point, because India is running a significant current account deficit. So for the currency, it definitely means that the currency will be under depreciation pressure. And more importantly is the inflation outlook for India. We know that the RBI is generally in the process to cut interest rates. But if the imported inflation is higher than expected in the future, I think the RBI, the room for RBI to cut will be relatively limited. I think RBI will definitely take a look at the projections of the oil price outlook. But of course, given that oil prices are on the relatively high level, as well as a lot of commodities prices are on the rise due to recent Chinese decent data, I believe that for RBI, they could take a relatively cautious approach at this moment to see how the inflation dynamic will perform in India. From foreign investors' point of view, I think the most important thing at this moment is the election results. I think for the foreign investors, they want to have a relatively stable political backdrop in India, as well as decent economic data, as well as relatively high returns of the bond yield.
Okay. Okay, have we lost How? No, How, can you hear me? Okay, I think there is some issue because I thought I missed what he was trying to say in between. But how's you, of course, talking about this being a concern in the minds of emerging market investors. While we wait for Zhou, since we are talking about global emerging market fund managers, let's listen in to Manraj Sekhon of Franklin Templeton Investments on why he believes that emerging markets like China and India are the places to be invested in despite the crude prices, because they may turn around sooner rather than later. Listen in.
EM has a long way to go. As I said, when you think about the relaxation in China, when you look at the elections we're seeing in India, that looks to remove one of the major uncertainties for EM. When you look at what's happening in Brazil in terms of reform, it's been a while since the breadth of EM opportunity is as wide as we've seen. Valuations are still attractive. As I mentioned before, the backdrop in terms of policy and stimulus is very positive. The US is going through a bit of a recalibration in terms of growth, and to your point on Europe, parts of Europe will do okay on the back of what's happening in the emerging world, but I think the bulk of Europe is still getting very inward looking. Growth is slow. You've seen monetary policy continue to be accommodative and quantitative easing persisting. So I don't think the macroeconomy in Europe is going to run away anytime soon, which means attention will have to focus on where we see positive secular trends, and that points us towards the emerging markets. It's interesting when you look at those crises, which got a lot of attention, places like Argentina, Pakistan, Turkey. If you put them all together, those three economies probably constitute maybe 1.5% of the emerging markets index. So if you put together the top 20 companies in the emerging markets, those 20 companies are much bigger than any of those countries put together. So those crises got a big share of mind, but they really didn't move the needle. Now those stories are behind us, and people are focusing on the bigger economies, the more sustainable ones, some of those we talked about already, like China, like India, potentially Brazil as well.
Well, let's see if the flows continue. How we missed I missed the last portion of your answer because we lost you, but you seem to be suggesting that this temporary bout of uptick in crude prices might deter investors, but the medium term doesn't seem to be all that bad. Did I get you correct?
Yes, I think the most important thing for foreign investors for Indian investment is the political stability. I think the election results will be quite important for them to have a relatively medium to long-term view on India assets.
Okay. Where are you on this whole growth versus the economic fundamentals debate when it comes to India? Growth certainly seems to be coming off in India, and back home there's a big conversation around it. I'm trying to think, what does somebody who look at economies across the world think about it? Because a 7% number or thereabouts, much lower than otherwise, is still amongst the strongest across the world, large EM economies or other economies as well. Does that hold India in good stead? And when you speak to your clients, do clients still speak about the Indian growth with a glimmer of hope in a world which is starved of growth?
Well, I think it's very interesting to watch the Indian data flows in the past few quarters. In general, I think the investors are still relatively confident that in the medium term, India can still deliver relatively decent growth. And compared to other EM economies, actually, India is relatively specially positioned because India is a very domestic-driven economy, which is kind of different in compared to a lot of EM economies in the world, because we know that a lot of EMs that rely on the exports, especially exports of commodities. But India is the other way around. India import a lot of commodities. So basically, as long as India's so-called demographic dividends continue, as well as the domestic market and reform continue, I think foreign investors still relatively hold a constructive view on India's investment.
Okay. How if what's the pecking order right now when it comes to EM economies? I mean, whether on the economic fundamentals front or in terms of where investors are willing to put in a big slice of the pie. China has this big trigger of MSCI weightages coming into play and valuations being in the favor. But if you were to look at where investors are favoring the most, what's the pecking order here?
I think at this moment, definitely China is relatively more attractive than a lot of EM economies at this moment. As you mentioned, the MSCI inclusion as well as the bond index inclusion for China. I think they're relatively at a sweet spot at this moment. But I think in general, the most important thing for EM is still the dollar outlook, especially the Fed rates outlook. To think about this, if the Fed continue to hike, I think which might not be the case, but if the relatively high interest rate in the U.S. and as well as the relatively strong U.S. dollar could continue, I think this will relatively bad or will provide some headwinds for the EMs in the future. So I think for investors, they have to have a relatively balanced view on that. One thing is that the fundamental growth in a lot of economies, especially in EM, but also you have to think about the interest rate differentials as well as the implications on the currencies between EM and the dollar. So I think in this case, at this moment, I still favor Chinese stocks and bonds at this moment. But in general, we have to still relatively take a relatively dynamic view on EM as a whole. China will not grow as rapidly as we saw in the past, as well as the geopolitical tensions were likely to continue or persisting in a lot of areas. So I think in general, we should have a relatively balanced view on EM as a whole.
Okay. Zhou, we'll leave it at that. Thanks so much for taking the time out and speaking to us today at Bloomberg Quint India.
Thank you.
Well, that's the global opinion, and Commerzbank believes that investors still favor India despite crude prices moving up. It may well be temporary in nature.
Yep, and we've seen at least the FI flows continuing despite of markets going down. We'll check for the flows today, Neeraj. But shifting focus to 5paisa Capital, a company which posted its March quarter earnings last week on 16th of April. And since then, we've seen the stock doing pretty well. On Thursday, it was locked in upper circuit with gains of 20%. Today, once again, and volumes after the numbers came in have picked up quite significantly. So today also the stocks trading with gains of nearly 14 to 15%. And by the way, the company turned EBITDA positive. Probably that's the trigger, and losses have narrowed that the stocks are seeing some bit of, it's been in focus at least post the numbers. Let's get let's shed more light on the numbers and get in touch with the CEO of the company who's joining us now on the show. Mr. Prakarsh Gagdani is here. Good afternoon, Prakarsh, and thanks a lot for joining us today. You've turned EBITDA positive for the quarter. You posted EBITDA of somewhere about 2.3 crore. Tell us, is it a result of good top-line growth, or there were actual operational efficiencies that kicked in during the quarter?
Very good afternoon, and thank you for having me on your show. See, if you see our all last 3 to 4 subsequent quarters, we have been continuously improving on our operational efficiency. I've been on your show earlier as well, and I've been saying the same thing since last 1 year, that what happens in a digital, the initial setup cost in terms of building your team, infrastructure, marketing takes a lot of cost. And then incrementally the costs are lower, and the fruits of whatever foundation you have built comes in with more and more customers trading and more and more customers getting added to your platform. So basically that is now kicking in, and even last quarter and this quarter, we've given a growth in our top line, and our costs have significantly been the same, or we have improved on the cost in terms of marketing and people and all. And that's the result of that, is that we are now EBITDA positive in this quarter.
Prakash, the losses too have narrowed. If I look at it, it's 33 lakh of loss that the company has posted versus year on year. I think the loss was somewhere about 7 crores. Sequentially also it's fallen. So can we expect the company to turn profitable in the next quarter?
Looking at these numbers, definitely we have reduced, and we are almost near to coming in green. But that is not taking away our focus from growth. So, we are right now at around 200,000 customers. We do almost like 3% of the market share. But that's a long way to go. We are not. Our first aim is to be in a top 2-3 broking companies in the country. So we are not deviating from our focus of growth. But yes, the cost and the focus on improving the operational efficiency remains. And if by that we come in green in the next quarter or maybe subsequent quarter, definitely it will be. But the focus will be definitely on the growth.
Okay, agnostic of 1 quarter, 2 quarters, Prakash, but for FY20, will you be posting a profit?
We would be definitely looking at it.
Okay. My next question is on the finance cost. I was just looking at the P&L account. The finance cost has actually risen to 2.4 crore. I also understand there is some rights issue which the company is looking at to raise around 100 crore. First, what's the total debt? Did it go up in the quarter gone by because the finance cost has been on the higher side?
So our debt is in the range of around 55 to 65 crores, and that is predominantly because we do margin funding for our customers, and that's the debt for. And definitely the rights proceed that we get whenever we're just awaiting approval, so I can't comment on the timelines for that. But yes, that will retire debt for time being. But the whole idea of getting the proceeds of the rights will be to deploy that for business and growth, and also on improving our technology and infrastructure.
Rights.
The idea would be
the money that you're looking to raise via rights issue. It will be used to retire the debt completely.
That's not the objective. Where immediately, yes, or definitely, it will retire the debt for time being. But the reason why we are raising capital is to deploy in technology, improve our product, start new businesses. We also have got an approval for P2P lending, and that's where some of the capital will definitely will go, and obviously on the marketing front to acquire more customers. So that would be the deployment of capital.
What's the target in terms of revenue from your lending business, which is going to be a new business? Will that be reflected from FY20 onwards?
It would definitely be reflecting in FY20. I won't be able to comment in terms of which quarter it would kick in, but right now we are in a phase of building our product and infrastructure.
A word, Prakash, on your client base. What's the sort of growth that you're witnessing on month-on-month basis? I do understand last quarter was pretty good and the current client base is somewhere about 200,000, but what sort of target can we expect in FY20?
So if for a full year, if you see, we have grown in terms of 2.5x of our client base. And we believe that we will be able to maintain or even accelerate the growth here on. So we should be expecting at least 150-200% growth even in this year or more, because we've not even scratched the surface as far as clients are concerned.
Okay. Before we let you go, what's the top line growth that one can expect for FY20?
It would be really difficult for me to actually give a projected numbers. But if you see our previous year, we have given again a 220% growth in this year. So it all depends on how customers take our product, and that's what we are getting feel from the ground, that people are liking our product, and we are adding a lot of customers. So the growth should be decent enough, or we should be able to beat our last year's numbers.
Okay, we wish you all the best for FY20, Prakash. Thanks a lot for joining us and taking us through the Q4 performance. That's the management of 5paisa becoming EBITDA positive, and probably, guys, that's the reason why the stock has been moving higher in the last 2 trading sessions. We've seen good amount of buying interest, which has come by 20% upper circuit on Thursday, and today it's up another 14%.
All right, volumes are also slightly on the higher side, but nonetheless, can't ignore a good set of numbers, and the stock's duly reacting to those. What's not doing well is the entire market mood right now. The Nifty worsens a bit more, so 11,634 on the index. Banks have lost about 430 points now, so I think this is the lowest point of the day for the Nifty Bank as well as the Nifty 50. It's pain across the board, even in the broader market space. We're going to pull out individual pockets and highlight for you what's reeling under pressure. And one pocket that doesn't go unnoticed in today's session, at least, has been the oil and gas pocket and the oil marketing companies in particular. All of them have witnessed heavy cuts of about 4.5% apiece. Remember, we are not talking about an immediate impact of this in quarter four. Quarter four has been fine. In fact, you would anticipate quarter four to be a better quarter for most of these oil marketing companies. But going forward into quarter one, considering that this is an election period, they're not allowed to raise fuel costs, as well as there is pressure building up with higher crude oil prices moving sharply to about 74. Sumeet Sarkar, he's joining in right now to tell us what exactly are the implications for the oil marketing companies and what's the way forward as we move into quarter one of FY20 now, Sumeet.
So if you see, usually higher oil prices should not have an impact on the oil marketing companies, and that is because of the daily changes that we see in the fuel prices. But if you see in this chart that we are just showing, right from the start of the financial year 2020, Brent crude prices have moved up nearly 8%, while the retail petrol and diesel prices in Delhi have remained at the same levels. Now, this disparity in changes of crude prices and fuel prices means that the oil marketing companies have been taking an impact of this higher crude prices on their marketing margins. Now, if you see in the fourth quarter, the gross marketing margins were at an all-time high for the oil marketing companies, and now they are expected to drop sharply because of this divergent move, which could put significant pressure on the Q1 FY20 earnings of the oil marketing companies. Now, this drop in margins will impact HPCL the most, as sale of fuels contribute nearly 60% to the company's EBITDA, followed by BPCL and Indian Oil Corporation, where it contributes close to 40% and 20% to their EBITDA. Now, if you see, however, this higher crude prices would result into some inventory gains for the oil marketing companies, because we have seen in the past that whenever crude has averaged higher compared to the earlier quarter, the oil marketing companies have reported an inventory gains. But currently, if you see, the street is factoring in this drop in margins and a possibility of further rise in crude prices, given the fact that USA will eliminate sanction waivers that earlier allowed buyers like India to import crude from Iran. So that possibility could lead to higher crude oil prices going forward, and given the fact that the retail prices have not increased, the marketing margins could further come under pressure for the oil marketing companies.
With us, Sumeet, also talk about Reliance Industries amongst the top nifty losers. We know about the numbers, but let's talk about the rising debt pile for the company.
So if you see in financial year 2019 for Reliance Industries, the total debt jumped the most, at least in the last 9 years, and that is despite the fact that the company had demerged their fiber and tower asset, which should have actually reduced their debt. Now, if you see in FY19, the total debt jumped by nearly 31% to close to 2,87,000 crore rupees, and this is on the back of the capital expenditure of over 1,32,500 crore rupees done by the company in FY19. However, a rising contribution coming in from the petrochemical segment, retail and Reliance Jio has kept the company's leverage ratio, that is total debt to EBITDA, at a comfortable level of close to 3.43 times, but the company's debt has increased nearly 31%. Now, if you see at the end of financial year 2019, Reliance Jio had transferred its tower and fiber assets to an InvIT. Now, because of this demerger, the company also transferred debt, that is bank borrowings and other liabilities, worth close to 70,700 crore rupees. Now, despite this transfer, the company's total debt has increased nearly 31%, which is a concern for the company going forward, because if you see now going forward, this transfer of asset will also lead to an increased cost for Reliance Jio in FY20, because they will have to now start paying the InvIT to use this tower and fiber assets, which could result into a lower EBITDA and profits for the company starting the first quarter of financial year 2020.
Okay, Swami, thanks a lot for bringing in all those details. Clearly, post the numbers, Reliance giving up the gains that we'd seen on Thursday. The stocks right now trading with cuts of nearly 2 to 2.5%. All right, that's a biggie with 10% weightage on Nifty. But let's move on and talk about KPIT Tech, which listed on the bourses today after its demerger. Agam Vakil is here with more details on the company. Agam, over to you.
That's right. Navneet, the price for KPIT Technologies, which was earlier known as KPIT Engineering, which was the demerged unit from what is now Birla Software, was at 100 rupees per share. It's currently trading at 105, so it's been a steady listing for this particular company. As we know that this particular company caters towards engineering services, research and development, and a lot of these processes are focused towards the automotive segment. As the management has themselves suggested that the company will garners a considerable amount of revenues, nearly all of them, from embedded electronics, mechanical engineering solutions towards the automotive vertical. And at this point in time, we spoke to the management and we asked them about what the growth prospects as well as the margins prospects were, and the management was very positive. They are expecting over a high teen growth over the next couple of years, and they're also expecting a considerable increase and improvement in their EBITDA margins. That said, when it comes to focus on the businesses, they'll continue to focus on mobility and automotive segment at this point in time, but it will have to do with technologies, and they are incorporating artificial intelligence as well as digital technologies to a lot of the processes, and as far as their revenues are concerned, they are very positive, considering they have enough exposure to markets such as Japan, Germany, China, as well as Brazil, other than India, and they continue to focus and remain with their larger clients, and that involves a lot of top 10 clients as far as your automotive industry goes across the globe. On the whole, the management seems positive, and the listing is in line with expectations and steady.
Okay, Agam, we'll leave it at that. Thanks much for taking the time out and giving us those details about one more new kid, but through a different route, but one more new kid on the block. However, it's the markets which demand attention. 1.5% lower, 436 for the Nifty Bank. Hemen Kapadia of KRChoksey Securities with us on the show to talk about his thoughts on the charts, as is Sumeet Bagadia of Choice Broking. And then, of course, we'll have Sameer Kalra on the fundamentals as well. But let's start off with the charts. And Hemen, let's start off with how is the market positioned today? How is it looking? It's certainly looking wobbly, so I can see that. Question is, can it wobble more from here? Can it go down lower? What's the trade on the Nifty Bank or the Nifty?
Well, frankly speaking, Neeraj, it was wobbly since last week. I was reticent. I was clear that it's uncomfortable. That's happened. We remain in the range. We were between 11,550 to 11,750. That has expanded from 11,500 to 11,850, but nothing changes. We were stretched, we were overbought, we remain so. But I don't think the levels have changed. Bank Nifty is 3650, 29,650. There is a downward bias. That should have been there, and that's there. We spoke about it. VIX is at 24. I think by the elections come, we should be 26, 27, maybe 28. So these ridiculous bouts of volatility will increase, but I don't think there's going to be too much of a downside, because the OI still remains safe at 11.5. We remain light as far as the Bank Nifty is concerned. Nifty is concerned. Bank Nifty is a bit better. So stock specific, there was froth which had to come out of the system. That's happened. So I wouldn't be unduly bearish. In fact, I think the markets will probably end positive tomorrow.
You think Bank Nifty is okay? 400 points down?
29,650. I'll take a contra buy call.
You take a contra buy call from these levels.
Or I will sell the 11. Last time I said I'll sell the 11,500 put. This time I'll say I'll sell the 11,500 put and 12,000 call, but the next month there's no premium this month.
Okay, that's the call coming in from Hemen. But Sumeet, coming to you, any strategy that you have on a day when Nifty's breached that mark of 11,650? Do you think we could also breach the 11,600 mark?
Hi, good afternoon. Well, yes, there is a possibility that we might see some more correction in Nifty next 1 or 2 days. For a day or for next 2 days, one can initiate sell positions in Nifty. Downside, there is a possibility that we might see a move till 11,580, 11,570 levels. 11,725 is resistance for Nifty. Till the time 11,75 is not taken away, it's better to be on sell side. Downside, if anyone wants to initiate a long position, then one should wait for 11,550, 11,520 levels, and those would be the good levels for to initiate long positions for next couple of weeks. Immediately for a day or two, for a traders, it's a good bet on sell side. One can initiate sell positions at current market price in Nifty. As far as Bank Nifty is concerned, yes, Bank Nifty is also looking weak for the targets of around 29,600 levels. Any pullback or bounce back till 29,900 should be used as selling opportunity, with the stop loss to be placed at 30,300 levels on higher side for the downside target of 29,600, 29,550 levels. This would be a very short-term call for next 1 or 2 days.
Today's move primarily led lower by private banks. Up until now, everyone was gung-ho over these private sector banks, but obviously this could mark a small dent but not change the outlook, right, for the entire sector.
So I think this is more like a breather, or you've run up too much. and results are now Axis Bank and Yes Bank give their results this week. So I think it's
HDFC wasn't bad at all.
Yeah. So, but it's like a pessimistic outlook also. Certain banks might taper off. Certain might result in a stable outlook. So I think over there is this kind of a hesitation to carry them towards the results. So I think there's this kind of a profit booking happening. It's not much to read into it. But yeah, that is certain because a lot of private banks have run up, whether you talk about Yes Bank or Axis or ICICI.
Okay, let's also get you some stock-specific ideas going in from our technical experts. Hemen, let me come to you first. You've got 2 buy calls.
Yes, I think some of these stocks are oversold from an intraday point of view, Navneet, and the ones I have, they've been oversold on the daily chart. They've been down much before the market correction started. So buy on Tata.com, 580, stop loss 573, target 594. Oversold, positive divergence in the early charts, crossover buys on the early, 2 early, 3 early charts. Buy on Sun TV, same logic, positive divergence, oversold. Buy at 595, stop loss 587, target 611. Navneet.
Okay, Tata.com and Sun TV, 2 buy calls coming in from Hemen. Sumeet, what about you in terms of individual stocks? What are you recommending this afternoon?
2 stocks for the day. One is on sell side, one is on buy side. Infratel is looking weak on charts. There is a possibility that we might see a fall till 290 or 288 levels. Any rise or pullback till 302, 303 levels in Infratel should be used as selling opportunity, with the stop loss to be placed at 311 on higher side for the downside target of 290 to 88 levels. The buy side stock is from IT space, and that is Infosys. Infosys looks good to me. It has given a good bounce back from lower levels. If today's closing is above 723, 724 levels, then that would be a sign of fresh buying in the counter for the upside target of 750, 760 in the next couple of days. One can initiate long positions at the current market price, with the stop loss to be placed at 690 on lower side for the upside target of 760 levels.
Okay, got that. So those are some stock ideas coming in from both the technical experts. A few other stocks that we can talk about during the day, and we'll get to it. Divan Housing Finance, for one, is a stock you need to keep an eye out on. The stock's down about 10% in the session right now. There's been a ratings downgrade on their commercial paper worth about 850 crores by CRISIL, and the stock since the morning session has bled out. And you can see 2 occasions where you've seen sharper falls, one at the start of the trading session in early morning trade, and the second just in mid-afternoon trade. So 141 on Divan Housing Finance. Sameer, housing finance companies, obviously we've not yet seen the numbers.
It's fallen. It's the top loser in Nifty right now.
Yeah.
So I think since starting only we've preferred HDFC, Canfin and LIC. We'll stick out with them only because Divan Housing, India Bulls still have a lot of source of funds issues. If their dispersals are going worse off quarter on quarter. So I think there is a lot of liquidity squeeze still in the markets. If you see commercial papers, they are not able to raise any funds out there. So I think, and NCDs is not a very cost efficient way of raising funds, especially when the rate cuts are happening like month on month almost. So I think these kind of factors really don't give the edge to these
You're not seeing
companies.
that in their cost of funds anyways, for any of them. It's not been coming out.
Because the only point is for them, the main source of funds is now going towards the NCD. So the NCD is always priced higher. That trend was there when the source of funds was commercial paper market. So you could see that impact quarter on quarter. So for a Canfin or a LIC or a HDFC, you'll see it on a 6 months to 9 months basis. You'll not see it on quarter because they already have a long-term book. So it's more of long-term funding source, which is more important now than the cost of funds, I think.
All right, so you completely stay out of this.
So it was a good momentum to sell out your positions which you were stuck in. I don't feel it's a place to buy or even look at a future long-term issues.
Shorts though, Hemen, would you short it? Divan Housing Finance or any of the housing finance companies? In between, you had brief moments where you had a Canfin Homes doing okay for itself, but nothing to write home about. What would your sense be?
I think India Bulls would be a safer sell, but it's already come to the support level around 740. So frankly speaking, Devina, it is a sell, but only if there's a bounce, because I think it's a bit late to sell them now. Maybe they go down further, but the risk-reward ratio for the previous swing high makes it unfavorable for a fresh short at this level. Yeah.
Well, the banks are facing the heat in today's session. Pull up the intraday chart of IndusInd Bank. I think that too is sitting at a day's low with cuts of nearly 4% right now, down 70 rupees in trade around the mark of 1693. And let me tell you the heavyweights. HDFC Bank definitely came out with the numbers, but that too has fallen, and it's about 10% weightage in the index that could be dragging alongside Reliance Industries. Sumeet, IndusInd Bank on the charts with cuts of nearly 4% in trade. Is there any trade do you see on the charts here?
See, there is a possibility that in next 1 or 2 days we might see some more correction in the counter till 1650 or 1660 levels. But the overall structure for next 2 to 3 months time horizon is good. So if we see a dip till 1650, 1660 levels, then that should be used as a buying opportunity. On higher side, the stock has resistance at around 1720, 1730 levels. Once the counter is able to break 1720, 1730 on closing basis, then we will see a good move till 1800 levels. So I think any dip till 1650 levels in IndusInd Bank should be used as buying opportunity.
Okay, 1650 is the level which Sumeet is suggesting. If it falls to that, one can probably look to accumulate. I guess it was weak even on Thursday's trade. Last 6 months down 16 to 17%. Sumeet, let's talk about the cement companies. It's an earnings heavy week. We've already talked about banks. There'll be a few numbers which will come in. But besides that, I think ACC and Ultratech also come out with the numbers. What's the expectation? Because I think this was the quarter where input cost pressures had eased off, and there is an expectation because it's the fourth quarter. The companies tend to push volumes at the cost of price. So what's the expectations from individual companies which are your favorites here?
So I think quarter 3 repeated itself. Volumes were up, margins were having pressure from the input cost pressure. In March they increased the prices, but there was a rollback 10 days after. How much kind of a rollback it eventually happened to be, that I think margins will give you an idea about. But I don't expect margins to come up. There might be a stabilization of margins quarter on quarter, or might be a little downfall. Because what happens, the transition of input costs, especially on the fuel side, takes a quarter to lag. And there's always a certain kind of a lag to reflect in. So that might come in quarter 1. I see She Cement in a better space of the whole situation, because over there the new capacity is playing a lot of operational efficiency.
The lowest cost producers, if I'm not mistaken.
Yeah, so they are lowest cost, and plus they are debt free.
They are debt free.
So
and
that
they're
gives
expanding.
them. Yeah. So on the north side, if you see, the prices have been stable. There haven't been much price cuts earlier, and I think that expansion of capacity is really helping out them operationally, and the valuations have dragged down because of the whole pack going towards a whole systematic issue. And I think the monsoon will get delayed in somewhere. So this will help in quarter 1, which the price hikes have actually come in.
You know, they too are looking at pan-India presence. I think they're trying to enter the south market. So the other player who has pan-India presence is Ultratech, which is a better buy at the current levels.
So I think at current levels, She Cement is better for me because of the debt levels as well and the cash flow they generate. So I think over there, She Cement is better in terms of valuation.
Okay, that's a cement pocket there. Shree Cement, though, has been down about 1% in today's session. Not a very actively traded stock. Volumes just about 8,000 odd shares on that counter. But nonetheless, from a long-term point of view, probably that's a better bet. Let's talk about the big elephant in the room this week. It's going to be big auto name like Maruti coming out with its results. Any fireworks expected?
Yeah, if you're expecting it towards the downside, then I think. Because if you see Jai Bharat, Maruti came out with numbers, right? Yeah. So if you see the numbers, they've already started reflecting the pressure of automobile industry.
Sure.
So the revenues came in flat, the margins took a big knock. I think same way Maruti can deliver that way. Because margins are now getting a big squeeze from the capacity cuts.
So that's been the trend last few quarters, where we have been watching out closely for margins. And at least quarter 2, quarter 3, that was the major drag for not just a Maruti, but for the other passenger vehicle majors as well.
So I think quarter 4 will be even bigger drag, because what was happening since November, October, they were having production cuts of 1%, 2%, 3%. But in March, they took around 20% production cut. So that actually kicks on your fixed costs and the amount of running you're doing. So I think over there, you'll have a fixed cost impact over there, and the margins will drag down even further. So I believe I'm still negative on auto pack right now. And these kind of bounces which came preemptive on the March numbers, I think it's a better strategy to lighten out.
Okay, we'll talk about even Tata Motors for that matter, and what's causing the stock to get so active. I think Darshan had a story up on our website on the same 5 reasons why Tata Motors has bounced back the way it has. But the focus is not Tata Motors in today's session, though it's actually a stock which has not fallen as much as some of the others on the index, but the focus is what's happening to crude oil prices and the effect of that on some of the oil and gas majors. Brent crude spiked to $74 a barrel in intraday trade today as the Trump administration looks to eliminate waivers on Iran oil sanctions. Let's speak to Peter McGuire, Chief Executive Officer at Exim.com, who's joining us on the phone line. Peter, thanks very much for taking out the time. Obviously, this is the biggest news that's driven the crude oil prices to do what it has, the waivers, and it's going to definitely impact India because we are one of the major importers of crude from Iran. So that's going to have a bearing nonetheless on us as well. But what is the sense, 74 to a barrel? Does it look like there could be more pain? Because it's not just about the waivers, it's about supply cuts from OPEC and OPEC Plus. It's about probable increase in demand coming in from China that could see prices being driven up because of the economic data that we've been seeing of late, what's been happening in Libya, a lot of moving parts.
Well, good morning, or good afternoon, I should say. Yes, there are so many moving parts, and that's not going to stop. I feel as though it's just been an enormous rally, as we all know, since Christmas. And these don't happen, it's really probably a 1 in a 5 or 1 in 10 year or longer time frame in the sense of the volatility that we've experienced in the last 6 to 7 months. And there's, I think, certainly further upside from here. It's been very strong trading during the day. The hedge funds are starting to really engage in this. And then, as you mentioned, that wonderful statement, moving parts. Venezuela, throw that into the mix as well. OPEC and OPEC Plus. And I feel as though that you've got the capacity to take $80 out for Brent. What that does to Prime Minister Modi and, of course, President Trump from their election campaigns, I think is going to be quite an impact to the consumer.
Just from an India standpoint, obviously, we are one of the crucial importers of Iranian oil. And, obviously, individually, when we've spoken to companies, they said that they have, their backup ready. They're ready to import from other countries as well. They've had standing agreements, and ahead of this possibility of the waivers getting revoked. A bigger blow for India, according to you, though?
Well, I think it is a double blow for many reasons. First off, you've had the election year. Secondly, like any nation, but really, I feel as though when you look at India, they certainly enjoy cheaper fuel prices, and I understand why. And you've got such a booming economy, growing on every sector, and a young, engaged workforce that's reliant on mobility and motor cars, motorbikes, and any form of motorised transport, which requires fuel. So it's a great impact to low-income young people and everywhere in the world, and it's the price that you achieved 5 months ago or 4.5 months ago is certainly a far different price to what you're feeling at the petrol pump right this second, and that greatly impacts buyer behaviour. I feel, some people say you'll see alternatives, and you might see an introduction back to ethanol and so on. The world has changed from really the 2005, 2010, where ethanol was a major contributor and all of this. Now you've got the US producing at record numbers as far as rig, and you've got the next part, the sanctions and the waiving of them, and John Bolton's aggressive stance. So I think it's a different world today than what we've experienced in the last 10 or 15 years.
Yep, it is. Nonetheless, mid-December, in fact, end of December, crude oil made lows of under $50 per barrel, and now we're staring at about $74 a barrel in a matter of just 4 short months. Do we start talking about $80 per barrel now?
We've got to. I think so. We're only 3.5 months in. When you're thinking of that from that Christmas, absolutely smashed to the downside. And it's been, there was a very, very, if I take you through the framework, I was at the OPEC meeting and that was around about the 6th of December. OPEC were fractured. OPEC were on the ropes. They were they had the wind knocked out of them. And they weren't sure what their behaviour was, what was moving forward, how do they compete against this, and they're just seeing crude just being smashed. And now they've got a different mindset. They've got, the world has changed. The world has changed dramatically in those 4 months. And any market that rises 50% in 3.5 months as crude, and that's one of the most major commodities or major trading instruments of the world, I feel as though there's more momentum. The hedge funds will start to drive it, retail traders, and you're moving into that Northern Hemisphere summer period where you have traditionally more consumption. So, yes, I think $80 is available, and I wouldn't be even surprised to take higher numbers than that. I can't say where it'll end, but if you have geopolitical hotspots, if you have tensions coming from the Middle East and what impact Iran faces in this, and where the US rig production, I feel as though there's more movement to the upside.
Just one last question, Peter. What is the most important thing now that's anticipated from the upcoming OPEC meet?
You know, there was an OPEC meeting I attended in Azerbaijan last month on the 18th of March, and that was a JMMC meeting, and that we were supposedly going to have an OPEC meeting this month in Vienna, and tickets were booked like it was cancelled, and now that's been moved to the end of June. There's another JMMC meeting in Jeddah, Saudi Arabia next month. I hope to attend that, and I feel as though that the method and the movement of the market has really taken a lot of people by surprise, and the hedge funds and the big traders have got profitability on their landscape. The turnaround has been that incredible as far as trading profits from hedge funds that I feel as though that every producer would have to be rubbing their hands with glee over the last 2 months of what's been accepted, and I feel as though there's more upside in the short term.
All right, got that. Peter, thanks very much for joining in. So $80 per barrel looks like a possibility, but obviously can't put a finger and say when that happens. But nonetheless, it is on the upside for crude oil. And this just not just put pressure with regards to what's been happening in the equity markets, but also, like in the morning we were discussing with our guest, and he spoke about this feeding into inflation and what the RBI stance can now turn out to be, because they've been talking about inflation being very comfortable. Now you start seeing crude oil, the joker in the pack being crude oil, and if that starts to rear its ugly head and feed into inflation, fuel inflation, that's going to defeat the purpose.
Clear and present danger, I would presume.
Yeah.
The only caveat to this would be that at some point of time when it goes above 75, and if it stays above 75, would the powers to be pressurize the OPEC Plus to go out and go soft on the cuts, which they haven't until now, in order to contain it. I know Donald Trump's tweets in the recent past haven't quite gotten the cartel or the club to go out and remove the cuts, but that remains a possibility and remains a hope that some of these crude impacted countries or economies would have.
So India was, I think, earlier exempted from that sanction list. They're
For the
trying
waivers,
to, from the waivers. So they're trying to do away with it now for all the countries.
Yeah, again, I don't know, Sameet might have some thoughts here as well, but I think one conversation that I heard was that
May 2nd onwards.
Yeah, one that, but more importantly that even in the build-up to the previous deadline as well, the expectation was that India will not get a waiver, or India and some of the other countries will not get a waiver. A week before waivers were announced, would there be an encore this time around? That's the
but there were some conversation with HPCL and IOC, those suggesting that they have alternate backups and they have agreements being done with other countries like South Korea and the other countries, and so it may not really affect them that badly. But obviously these are just short-term measures that will cover up for the gap that they witness if all this comes into play.
Sameet, any thoughts?
So I think it will impact companies, because if you see IOC, they book every first 10 days, they book for the next month. So this month they haven't booked anything. So May will go blank from Iran side. And we import around 600,000 kind of a barrel per month. So that will impact the supply. But what is happening that we are requesting US to increase the supply, because they have special reserves, which I think they will release once this kind of May 2nd sanctions kick in, because they have a lot of special reserves and that can impact the whole supply market. And I think even OPEC in June only will take a decision whether to come back towards a compliance or not, because right now they're over compliance, and especially Saudi, which is going even further than what they are compliant with.
Well, it's showing in the way the stocks have corrected, though, for sure. In today's session, all the oil marketing companies under some serious stress. You guys have discussed the housing, Indiabulls Finance, Yes Bank, and Diwan Housing in detail, yes, and the CRISIL downgrade leading to this fall. But it's very, very interesting because on the way up, all of them didn't move up in tandem. But in today's session, the last couple of days, there have been times in the past, recent past, when they tend to move in tandem, and today is one such day, right? I mean, Diwan Housing sees that downgrade, and PAT, we see a pullback in both Yes Bank as well as Indiabulls Housing Finance. So that's the other interesting piece that has happened. Sami, the last, I mean, before we take a break, just one question on the other sensitive, which is autos. They were just the last 2 weeks, the Nifty Auto Index was the best performing index. In today's session with the other rate sensitive, it's come off as well. Where are you out here? Are you bottom fishing, or are you believing that it's best to cut out your exposure? And Eicher Motors in particular, I know you spoke briefly about what's happened in the auto space, but Eicher Motors, which is that one auto stock, which unlike a Maruti or some of the others, has just not bounced back and is falling pat again.
So I think Eicher Motors taken into, kind of positions institutions have, and the trust on the growth which was there, that is kind of tapering off. So the situation of that growth and the pile up, if you see at the dealer level, is still very much there. So even in March, they haven't been able to reduce the inventory as that drastically as they wanted, or the dealers wanted. So I think there's still pain over there. The numbers will show even a smaller growth, I think, in April and May. So I think that gives a pressure to Eicher, and any kind of bounce in auto stocks, which you have seen in past couple of weeks, I think it's a very good place to get out of them rather than entering and hoping the whole reversal has come through. Because if I see April as of now, the registrations are down by 15%. So I'm not very optimistic about auto stocks, at least in the near future.
I'm not an Eicher either. Okay, let's wait and watch what happens. Just before we take that break, I want to mark what's happened on the broader markets, some top gainers and losers in the last few minutes and hours of trade. There aren't too many stocks which have gained, except for maybe a Granules India, which certainly has had some gains, but a fair bit degree of losers. Jammu and Kashmir Bank has corrected. There is some bit of loss that has come in to Indiabulls Real Estate from the highs that it was trading at, and tire companies too. Apollo Tyres in particular is trading nearly at the lowest point of the day. Tires, we'll talk about them as well on the other side of this break. Let's slip into one. But as we slip into that break, hear out Mahesh Patil, co-CIO at Aditya Birla Sun Life AMC, who spoke to us earlier today and said that the exposure to Jet Airways is minuscule and they've gotten out of it, and that hardly caused any impact on the net asset value of the schemes. That and his views on some other aspects. Hear him out.
It's important, I think, when we are managing public money and on the mutual fund platform, your risk management practice is what you follow, right? What are the exposure you take at the stock level and the overall risk at the group, and within schemes is something which we monitor very closely. And that's where actually we try to contain our risk, even if at all there are any stock specific issues which could come up, over a period of time. So that is where we try to limit ourselves. And if you've seen some of our fund, we mentioned about Jet Airways, our exposure that has been minuscule. It's been 0.5% in the fund. It's been a historical holding. We were looking at some kind of a resolution over there. It didn't happen. We were taken a decision and we exited out of the stock. But overall impact on the NAV is very, very minuscule, right? So it's a question of how you manage the risk in your portfolio over a long-term period of time and deliver returns to investors is what matters to the investor. There could be a short period, where there could be some impact because of a particular stock or large exposure. But if that risk is contained, and that's what the beauty of the mutual fund platform, right? That you mitigate, you diversify across companies, across sectors to really take care of the risk associated with a stock or a particular sector. So I think that is something which we keep in mind, and that really protects us from some of these extraneous events at the stock level or at the sector level, which can come in at any point in time.
The biggest opportunity, according to you, for the equity markets till the end of the year? one aspect that you feel is going to be the biggest opportunity, and also probably a threat to the rally that we've been seeing? What is going to be the biggest threat that is a little bit of an unknown right now, which is probably not baked in?
So I think the opportunity is always, there. I think for long-term investors, equity markets, irrespective of what time they come in, we've seen as long as you stay in the market, as long as their time horizon is longer, I think you should make reasonable returns. And the market, while at these levels looks expensive, I think one should not forget that the earnings are a bit depressed, right? So it's at an average level. So one should expect more or less average returns from this market over the next few years. But that is still good, I would say, compared to what return other asset class could offer, and looking at where the overall inflation level is. Risks, I think, is very difficult to say what could play out. I think we've known certain risks, but markets tend to really ignore them at certain points in time. One obviously is, as you mentioned, I think we are on the fiscal side, there is some amount of limited room the government has, right, because of the various measures government in terms of distributing money. And also we've seen tax collections hasn't been to that extent. So in that context, if there is a pressure that either oil prices go up and shoot up, I think there could be some risk which one could see onto the market. Election is another uncertainty which Mark keeps on talking about it, though I would say historically we haven't seen too much volatility because of elections, say 6 months after the elections. Yeah, in the near term, I think that could be another risk factor, which one could look at. But I think markets, all risks have always been there in the market, right? It's the opportunity, I think, which we need to look at if you really want to.
So you're saying even at these prices, it's a good entry?
It's a reasonable entry. I would not say you would make big returns from these levels, but I think you need to be in the market really to get returns in longer term, and any opportunity you get because of some of the risks which come in and the market's correct, I think it's a good time to really enter and increase your chances of making higher returns from the market.